Hey everybody, welcome to Non-Trivial. I'm your host Sean McClure. In this episode, we're going to take a look at a number of interesting concepts related to the madness of crowds, but also the intelligence of crowds. We're going to take a look at some of the manias that go on in economic bubbles and in the world of cults. We're going to take a look at biases that come into play and why, when a bunch of people get together, crazy things seem to happen, like cognitive dissonance and confirmation bias, some of those biases that play a role, and how that relates to some of that craziness that we see in crowds. We'll take a look at what all that means in terms of complexity and how there's an actual cost to complexity. In other words, I'll frame this in terms of this so-called madness that occurs in aggregate in large crowds is actually something that needs to happen to make long-term stability possible. Take a look at scale dependence and narratives and how some of that turmoil and collapse is absolutely needed for long-term stability. So let's go ahead and get started. Okay, things only look crazy when you stand too close. So let's take a look at what I mean by that. Go ahead and if you would like to support Non-Trivial, please go ahead and head on over to patreon.com/nontrivial, and you can, for a little bit of, a few dollars a month, you can help support the show. You get access to the slide decks that I use, some of the visuals that I put together, a little bit of extra media, sometimes a few little goodies in there, like, some piano composed by yours truly, like we did on the last episode. I try to keep things a little bit interesting, but basically some visuals to help anchor the narratives that I put together in these episodes. For those of you on Patreon already, you can see the overview slide for this episode. We're going to take a look at a lot of interesting concepts, but let me just skip ahead to the book that I will use this week to anchor the conversation. The book is called The Delusions of Crowds: Why People Go Mad in Groups by William Bernstein. The Delusions of Crowds: Why People Go Mad in Groups. And so this is a common pattern that we see, well, throughout all nature, obviously. When large number of organisms get together in aggregate, they produce behaviors that cannot be explained by the individuals themselves. Of course, that's a hallmark of complexity itself. And one of those patterns that can emerge is what this book calls delusions, or what a lot of researchers and individuals would consider delusional or mad. The common example being things like a stock market bubble, right, where people start investing like crazy, and despite evidence to the contrary in terms of the viability of the company that they're investing into, or the set of companies they're investing into, despite that contrary evidence, people just keep kind of pumping the money, and this bubble grows and grows and grows, and eventually explodes. And then in hindsight, you kind of look back and say, okay, well, that was stupid, right? Like there was all these obvious red flags. Why did people do that? Of course, hindsight is 2020. But there is a certain kind of madness and almost delusion that seems to occur when a large number of people get together. You can see this even in, the stampedes that might happen. Something little sets it off, and all of a sudden it propagates throughout the crowd, and you've got this kind of madness. So we'll take a look at that pattern, this kind of madness, this craziness that happens in groups, where that comes from, what are some of the underlying mechanisms. We'll use that book, The Delusions of Crowds by William Bernstein, to kind of see his take on it. And I'll agree with some parts and disagree with some other parts. But we'll take a look at the properties of those bubbles, of that madness that happens. And anyways, for Patreon subscribers, you can see the list of patterns and concepts we'll talk. I'll be talking about throughout this episode. But yeah, things like emergence, right? The limits of logic, sustainable growth, biases, tractability, scale dependence, narrative fallacy, and decisions with heuristics. So let's go ahead and get started. Okay, I want to start with this System 1 versus System 2 thinking. Daniel Kahneman is a very famous psychologist, Nobel Prize winning psychologist who wrote a book called Thinking Fast and Slow, and this is the way a lot of people will frame human thinking nowadays in terms of the system 1 and system 2. And it's not a bad way to kind of think of the two ways that people typically think of things. One is what he calls system 1, which is the instinctive, unconscious, fast, associative, emotional way of thinking, and the other is system 2, which is more slow, reasoned, and analytical. Okay, so in everyday life, when we're faced with a situation, we tend to think in one of two ways, right? We either use our system 1 mind, which is the more kind of reptilian, been around forever, at least 50,000-year-old mind, where we are unconsciously just acting very quickly, doing things based on instinct. It's very associative, it's very emotional, right? And this constitutes, you could argue, let's say up to 95% of our thinking, right? We just use these kind of high-level heuristics. We do things very quickly. We use our gut feeling. And that's how we navigate the complexities of life. And then system 2 is that where you kind of slow it down. You try to be more reasoned, more logical, more analytical. It takes a lot more effort. And that's kind of the rational mind. And you could say that's probably only about 5% of the time in most people. But that would be the breakdown, that system 1 versus system 2, the kind of emotional, fast stuff versus the slower, rational stuff. And the usual narrative around this that you always hear is that 2 is kind of the more advanced, the more kind of enlightened, suitable way of thinking to modern life, right? You always hear people talking about how, people aren't actually that good at thinking statistically or probabilistically. They don't know. Most people won't break a problem down into its components and try to be very logical about how they add up to some good result. They'll just kind of be emotional, or they'll base it off gut instinct. And so the usual way this system 1 versus system 2 thinking is framed, and I'm not saying Daniel Kahneman is necessarily framing it this way, but most people will talk about these two ways of thinking in terms of system 1 being kind of archaic and kind of not really suited to modern life, whereas system 2 is something that we could all use more of. That's the usual narrative. And I'm going to argue against that a little bit. Not that idea is completely wrong, that there's this mismatch between, system 1 thinking and modern life. I mean, there is definitely a mismatch there, but that is not to say we should be walking away from system 1. And I had this kind of talk that I give a lot about coming full circle, right? How a lot of technologies today are actually getting us closer to what I think makes system 1 more suitable to modern life. But I'll talk about that a little bit later. In the book, The Delusions of Crowds by William Bernstein, Bernstein talks about system 1 essentially leading to mania, right? That's kind of how he frames this up. He says group decisions, he sees those as illogical and dangerous, right? So the decision-making that happens in groups is not something that's relegated to just the individuals, right? The groups can, quote unquote, decide as well. And we think of that as an emergent phenomenon. I've used, the ant colony and the termite colony as examples a lot, right? Nature solves problems by taking a lot of little pieces and running them in aggregate. And the aggregate, or the group of all those organisms working together, is actually how the decision-making happens, quote unquote, decision-making, how the problem solving happens, right? That's how complex problems become tractable. So these decisions can be considered mania, though, as though there's something wrong with them, if it leads to poor outcomes, right? So if you have a bunch of organisms or individuals, let's say humans, coming together and they operate in aggregate, and it leads to something, quote unquote, bad, whether that was, people getting stampeded, right? Trampled in a stampede, whether that's people investing in something that they shouldn't have, kind of the propagation of these bad narratives that end up happening at large. We can think of that as a mass delusion. So anything that kind of leads to a bad outcome is framed by Bernstein as essentially a system 1 leading to mania. At least that's the way I kind of interpreted it from his book. So that makes us think, well, what is modernity's, right? What is modern life's definition of delusion, right? This idea that system 1 is leading to deception. Well, to believe that, you have to think that anything outside of a logical framework, a strictly logical framework, is deemed wrong by today's standards, right? So, if you're looking at a situation, and again, kind of in hindsight usually, but you pick it apart and you say, okay, all these people, let's say, joined a cult or threw their money at something, and when you look at all the, wrong things that occurred, and not just on the output side of things where, obviously bad things happen, but you kind of look at the decisions that seem to be made by the individuals that went into it, or what the group decided to do at large. It seems kind of ridiculous. Why would they do this? Why would they do that? It doesn't make sense. So from a strictly logical framework, it's deemed wrong. It's deemed delusional. It doesn't make sense. But recall my episode on the limits of logic. I had a 2-part episode on this, a couple seasons ago, where in the first season, where I looked at the limits of logic. And I argued that while logic is definitely powerful in a lot of contexts, it also leaves a lot out, right? It by definition strips out much of the context that makes a situation what it is. It frames situations in an overly simplistic fashion where all the different pieces come together and they sum together to produce the final result. And if you can't see how those different pieces sum to produce the result, then you almost, society tells us that's almost like a failing, right? It gets fuzzy, it gets messy, and therefore it's not in the realm of logic, and therefore it's hard to make sense of, and therefore it's there's something wrong with it. In other words, if you can't understand how the pieces came together to produce the result, we tend to think there's something wrong with that. But of course, that's ridiculous, right? Because the overwhelming number of phenomena in real world life are synergistic, right? Where the whole does not equal the sum of the parts, right? We cannot take that reductionist approach and peel back the layers and find how those components act together. We can't understand how the sum happens. In fact, it's not really a sum at all, right? There's this complex interaction of all those components. So the reason why I'm saying that is modernity's definition of delusion is not necessarily a delusion. There might be a higher purpose to it, if that's the way you want to say it. In other words, if you step back and look at the more holistic, larger picture, you can begin to understand that maybe that wasn't so delusional. Maybe there's a reason that things work like this, and maybe that's just a cost of, that there's these things that are not that great, but that's a cost of how complex problems get solved in the long run. So I'll talk a little bit more about that later. But I just want to point out that when we say something like the delusions of crowds, that is not like a factual statement that, when something quote unquote goes wrong, it was definitely wrong, or it's definitely delusional. In other words, if people invest in something really, really stupid, yeah, in hindsight, you can say that shouldn't have been, but that's in hindsight. And if you step back and see the more holistic picture of the entire market, you might realize, well, that actually needs to happen. In other words, to give a more concrete example, if you wanted a stable economy, if you wanted a stable market, one of the costs to doing that is to have bubbles that burst. You have to have things go wrong. And I'll give examples in nature of this a little bit later on. Okay, but just keep that in mind, that when we say things are delusional, when we say things like the madness of crowds, the quote unquote madness term in there is subjective, or is only mad or crazy under a very narrow definition of what correct is. And that's that strict, extremely naive logical framework that we typically use to define things as correct. Remember in my episode, I was talking about science saying more but explaining less. I talked about the great disconnect. It's this idea that only under the very contrived laboratory settings do you tend to say, well, this is true and this is right and everything else kind of isn't. But if you actually, let the complexity go, so to speak, let that run its course, all that context that you stripped away in order to define something as quote unquote true was actually absolutely critical. I talk about those hidden dependencies that make something what it actually is. So anyway, go listen to that episode if you want, but it's kind of related to that pattern. But let's jump into some specific examples now. There's a lot of these kind of madness of crowds or mania examples that have happened throughout history. I'm going to use take the economic side of things for this episode for the most part, although I'll talk a little bit about cults later on. But when we think about economic bubbles, right, those are always interesting, right? You've got this kind of speculating frenzy that happens in society, for whatever reason, a number of reasons, a particular company or domain becomes very interesting to many people, and the economics of the day, the banks and the governments make it possible for the everyday citizen to essentially, put some of their money into that. And there's all this narrative baked in, and there's this feedback loop that happens, and people just keep speculating and getting, almost overly optimistic about situations, and so much so that many people will actually pump all their life savings into something, and then of course it grows and grows and grows without valid reason, and then collapses. And what I mean without valid reason, if you remember my episode on the WeWork example, right, you had this kind of relentless growth, but there were these, there was no way to backfill that growth with something real. And it's kind of like the Malthusianism, right? This idea that you're growing, but you don't have the resources in place to actually backfill that growth with something. In other words, the growth of something can outpace the reality, right? You can grow something from an informational standpoint, whether that's via digital currency or money or just something that's more informational, but the physicality of the thing has to catch up to that informational side of things, right? And I talked about that in the WeWork example, where you got the separation between the informational side of things and the physical side of things, and eventually they have to catch up to each other. So anyway, let's take a look at some of these economic bubbles. I think they're pretty interesting. So the first one, what history would normally call kind of the first major economic bubble, was the South Sea bubble. Okay, so there was this South Sea Company, which is a public-private partnership, and this was done to essentially consolidate and reduce the cost of the national debt. Okay, this is in Britain. After 2 wars, there was this massive amount of debt, and they needed to try to solve that. And so what ended up happening is they created the South Sea Company, and the government granted a monopoly to supply African slaves to the islands in South America. Okay, so there's obviously at the time, we're talking early 1700s here, and you've got slave trade, and you've got slaves being essentially sold to South America, and Britain is obviously playing a large role in that. And so by creating this public-private company, the South Sea Company, and then the government granting a monopoly to essentially capitalize off the slave trade, that caused a speculation frenzy. Because if you're looking at this as kind of an everyday citizen and say, okay, well, there's the slave trade going on, and that's obviously, for lack of a better term, a hot market, right, at the time. And you've got this company that has a monopoly on that, and that monopoly was granted by the government, and they're doing this to get rid of their debt. It looks like a situation that could be quite profitable. And so the company's stock rose greatly in value, largely via propaganda, right? And the reason why it was largely propaganda is because there was this war going on with Spain at the time. There were essentially all these reasons to not believe this was not going to work out particularly well. If you kind of picked apart, did the fundamental analysis of, if you will, of the company and the market and the culture and what was going on at the time, again, hindsight's 2020, but you could see that there were obviously a lot of red flags there that this might not work out too well. And that was the case of the South Sea Company. The company stock rose greatly in value via a lot of this kind of propaganda, because they were just trying to raise money and they were trying to get rid of the debt from the 2 wars. It peaked in 1720 and then collapsed, and it ruined, just thousands and thousands of investors. So it's kind of one of the first examples of, government runs into a problem, they form this company, and they put all this propaganda behind it. In this case, the government's involved. And the company, just through that massive speculation, grows and grows and grows, at least on an informational side of things, and then it collapses. And people who were just pumping money, of course, don't reclaim that investment. There's no ROI on it. They lost a lot. And so it crashed. So that was kind of the first well-documented, mania of crowds example, where people went crazy and they invested, and then we had the market crash, or specifically the company crash from it. And then another example would be the British Railway bubble. So this is going back to the Bubble Act. So in 1825, the government had repealed the Bubble Act for whatever reason, right? So time goes by, people's memories are short, and there's this potential new opportunity to get, raise a lot of money through investment and grow a very big company. Railways were obviously being laid down at a very rapid pace, and if you look at it, it makes a lot of sense. Think about the internet today. We'll use the dot-com bubble as an example in a bit. But if you're alive at a time when a new technology comes around, and it just makes so much sense, as obviously rail did at the time, and you've got this major player in that domain, you get into this over optimistic speculation again. And so much so that in 1825, the government actually repealed the Bubble Act, and meaning that kind of like whatever regulations were put in place to not let, the South Sea bubble situation happen again was kind of pared back a bit. And people started to invest, their entire savings into prospective railway companies. And so a number of railway companies were involved, and they raised a lot of money. So that mania reached its zenith in 1846, and dozens of rail companies formed, but their unviability eventually became clear. And again, things crashed. So you've got this overinvestment, over optimistic speculation. You grow the bubble, and that falls down. And that collapses. Again, what's interesting here, I think, is that, you had this Bubble Act in place from the South Sea bubble, right? The South Sea Company disaster in 1720. 100 years goes by, and and people start putting things in play. Well, maybe this is okay. This is different this time, right? It's always different this time. And so the same thing kind of happens. Obviously, the most famous example, I suppose, throughout all history would be the 1920s stock market crash. Okay, this is an example of essentially borrowing going crazy. So in the autumn of 1929, right, share prices on the New York Stock Exchange collapsed, as we all know. And of course, that signaled the beginning of the Great Depression. So if you think about, obviously you can go read all kinds of reasons behind this and the mechanisms at play, but one of the main core mechanisms was that brokers were routinely lending small investors more than 2/3 of the face value of stocks. Okay, and so basically what that means is, a bunch of people, think of the housing crisis, right, of 07, 08, where a lot of people were basically able to buy things that they were not supposed to be able to buy. This is a common pattern that happens again and again, right? And so the banks or the brokers are able to kind of lend investors who really shouldn't be able to get into this because they don't have the money to do so. They start lending them money so that they can do that. Obviously, there's a reason that the banks would do that, because they can make a big return. People want to do that because they can start buying things that they wouldn't otherwise be able to. It's like, if you're making not a lot of money, you probably shouldn't go buy $60,000 vehicles, and yet people can do that all the time because banks are able to lend that money out. But this was $8.5 billion out on loan, okay, in the 1920s, and that was more than the entire amount of currency circulating in the United States at the time. Okay, more than the entire amount of currency circulating in the United States at the time was lent out on borrowing, and so investors couldn't. So it got. So kind of stepping back, you've got the situation where you got the Roaring '20s, right? It's after that first war, World War. You've got a lot of optimism. New technologies are coming out. Businesses are starting up. You've got all this, hey, everything's great. Banks are feeling the health of that economy, so they're lending. They're getting more aggressive. Investors are trying to capitalize off that. They go on margin. Okay, so this is where the broker essentially lends you, an investor, an amount of money. You borrow that, then you use that borrow money to essentially amplify the potential returns you can make on the investment. Of course, it can also amplify the losses you can make, so it's very risky to borrow on margin. But you saw that in the mid to late 20s, and basically, eventually, if the value of all the assets that you have drop below a certain value, then you have this margin call where the broker kind of calls you back and says, okay, you need to either you got to pay me back to get the amount of assets in that account up to a certain level, or you got to move stocks from another account over to this one. Basically, what you own cannot drop too low, or the person who lent you money to make that happen, to make the good stuff happen, the return is going to want you to essentially pay back a lot of that money or get stuff into that account. So anyways, so the things start to go down with all the investments being made in the 1920s. So the brokers started calling in the margin, and investors couldn't make that margin call because they had obviously borrowed too much and they didn't have enough money or other assets to fill it back. And this is when the collapse happens. Okay, so it's the same pattern. It doesn't matter. It doesn't matter if you're looking at 1920 stock market, British Railway bubble, or the South Sea bubble. You've got this informational aspect of things, that this ephemeral kind of money is out there, which it's not always obviously tied to physical things, right? It's supposed to be. It's supposed to ultimately be tied to physical things, but it's easy to make it not that tied, right? You think about a lot of the financial engineering that goes on, where people start to mathematically layer on different financial instruments, and then it gets further and further away from the underlying physical asset that it's supposed to represent. And this allows things to grow at rates that are far beyond what the underlying physicality would normally allow. Now, a little bit of that can be good, but it can easily get out of hand. And this is just another example. So you can just lend money. And there's this kind of unrealism that happens in the investment world. And if it gets too bad, and you got this massive leverage, you get this massive amount of margin, whatever, borrowed money, whatever you want to call it, you have this underlying gap that needs to be filled. And if it gets to the past the breaking point, then that's the collapse. There's nothing to fill in the big gap that's been created. Again, I like to think about that as the informational aspect of things being separated from the underlying physicality of things. Okay, it's really the fundamental pattern that's happening here. Okay, and I laugh because in hindsight we can always look back and say, well, yeah, this this was obvious, right? But yeah, again, in hindsight things are always obvious. But that's not to say that there aren't definitely red flags. And people have before bubbles, there are always individuals, or before collapses rather, there are always individuals who do point to say, look, this might not work out too well. But it doesn't seem to matter how many times this happens, right? And that's not to, when I laugh, I'm not disregarding the lives that get ruined from these things, obviously. But look, there are fundamental patterns here that do have a predictive aspect to them. A more recent example would be the dot-com bubble. Okay, so mid late 90s, the internet is starting to take off, really become popular. You get a lot of these internet companies, thousands and thousands of internet companies start popping up. And just kind of like with the railway example, right? You've got this new technology, the internet, which is bringing together unrelated buyers and sellers in these seamless and low cost ways, and the potential is just massive, right? So it led to excessive speculation of internet related companies in the late 90s. NASDAQ rose, 400%, and it actually fell 78% from its peak. So when it collapsed, what we call the dot-com bubble, right? So the internet companies are all forming, they're getting tons of investment. People are, borrowing money and investing in companies. And then again, there's nothing to backfill it. And this is particularly strong in internet companies, right? When we're looking at WeWork, we had this real estate company who was essentially pretending to be an internet company. Internet companies, because they're based on software, are basically fully informational. So they can really, really rapidly grow. They can scale like crazy. But they still have to be tied to something real. There has to be a viable business there. And if there's not, there's a problem. So NASDAQ, during the dot-com bubble in the late 90s, rose 400%. It fell 78% from its peak. It gave up all its gains during the bubble. So whatever gains it made during those rapid investment was given up when it collapsed. And this is another common pattern that you see, in all complex systems, right? That kind of the fat tails of things. If you look at the distributions, you've got, it's those rare events that end up dominating over the long run the properties of things, the reason behind things, the collapse, right? So in other words, you can make money, and then you could lose everything that you made, let's say over 10, 15 years, you could lose it in one day. So the one day is extremely rare event, yet it had the overwhelming domineering effect on the entire system, right? Everything was basically dictated by what happened in one day, not the 15 years. And so that's why you get into trouble when you think history alone is going to tell you what's going to happen next. People come up with these predictive models and they try to forecast based on patterns of what came before, but sometimes what came before won't matter because it'll just take one catastrophe, one day of something happening to wipe out everything that happened up to that point. So this happens again and again and again, right? This is just a fundamental property, essentially, of complex systems. So in this case, the majority of technology startups that raised money and went public folded, right? Like almost all the internet companies just folded and were no longer. And so you had these telecommunications equipment companies that invested more than $500 billion at the time. And most of that was financed with debt, right? And a lot of this went into the laying of fiber optic cables. And it's not all bad. There are some good things about that. Okay, I'll talk a little bit later, like laying of fiber optic cables. Like even though most people collapsed in the process, there was good that came out of it. In the British Railway bubble example, even though most of those rail companies were unviable and got destroyed in the collapse of the British Railway bubble, you still laid the overwhelming majority of rail that gets used today, right? So there's still some benefits there. But we'll talk a little bit about the benefit of turmoil later, which I've also brought up in the library episode. Okay, so what are we? So my examples here were the South Sea bubble, the British Railway bubble, the 1920 stock market, the dot-com bubble. Getting out of the financial side of things, we also have another Mania example in end-of-world cults. Okay, so this is not an investment. This is now the cults that form throughout history, where people buy into kind of these really, really crazy narratives. Again, there's always that hindsight bias there, but some really crazy things, and we can distinguish. There's always a bit of a touchy subject when you try to make a distinction between cults and religion, and people kind of sometimes get upset about that because, well, it's easy to call what somebody else is doing a cult and not what you're doing a cult, right? If it's not your own religion and all this kind of stuff, but generally speaking, if you take a look at what society defines as cults, you've got some what you might call really, really crazy stories that people are buying into, like really kind of edge of the distribution kind of things that most people just would not buy into, right? You got the 16th century Anabaptists, the Adventists, or the Millerism that came about. A lot of these have end of times narratives that are very, very extreme. And a lot of them, the ones that are based around the Bible, are usually, transmuting the Bible's ambiguity. Okay, so the issue is that whenever you have, and of course it's not just the Bible, but whenever you have Something like the Bible, which has a lot of flexible interpretation around it, you're always going to have a small group of people who take that to the extreme. In other words, they bring just absolutely what you might call crazy interpretations of what they read. So an example would be, and you can do this with anything, but again, because the Bible plays such a large role in society, it tends to be the anchor or the target to a lot of this stuff. This kind of numerology that people will do, well, they'll start finding patterns in anything, right? So they'll say, well, this chapter of the Bible mentioned this and happened this many times, and that same number appears in this book over here, and maybe there's a connection, and they start building and building and building, and pretty soon you create this whole narrative around the numbers and in the Bible and the meanings behind the words. And again, it doesn't have to be the Bible. You can do this with anything, right? In fact, as I'll talk about in a bit, you can even do this with science. It's not immune to this, but you particularly see this in areas where there's a lot of flexible interpretation possible. But if you do enough of this kind of numerology and these connections and this pattern finding, you can eventually put together a narrative that sounds fairly realistic to at least a number of people, right? It's kind of like the flat Earth society. You can convince people, in fact, you can do it using purely logic if you wanted, that the Earth is flat, right? And some people will buy into that. There's a number of, you can come up with all kinds of examples of just flexible interpretation, allowing people to put narratives together. In fact, one of my earlier episodes, I think I was talking about, the 9/11 towers, right? Or the Twin Towers, sorry, during 9/11, where you've got these conspiracy theories where maybe the government brought down the towers, right? And you can use purely logic. You can just take a look at, well, here's the plumes of smoke coming out. Here's the rate at which the building fell. You can use nothing but facts, but you can use it to piece together a narrative that is, by most people would agree, is fairly nonsensical. Who knows? I'm not here to say whether conspiracy theories are correct or not, but the point is you can make a lot of these really crazy narratives then, and you can get enough people together to buy into them. And the book, The Delusions of Crowds by Bernstein, uses the cults as another example. In addition to economic collapses, it uses cults as an example of this kind of this delusion that ends up happening, this mass delusion. People get together, they feed off each other's interpretation of a book like the Bible or something else, and you get into this feedback loop, and you get these really crazy narratives, and when I say crazy, I mean things like that are well beyond anything the Bible would talk about, as an example, right? It could be like the aliens are going to come, and UFOs, and they're going to take us up to heaven, and just really, really bizarre kind of stuff, right? Again, to each their own, right? You're allowed to believe whatever you want. But most people would agree that this is taking the interpretation of something, to the extreme end. And so there's a kind of mania to it. There's a kind of delusion, most people would agree, to things like that. And again, as I say, we can define these things as the bad outcomes. So a lot of these cults that have these end of times narratives to them end up in mass suicides, right? Or at least I shouldn't say a lot, but there are a number of definite ones that have been, over the last few decades that have ended in, up to 70 people, committing suicide, basically in one shot. And so you can go look at those cults. So that's another example of many people getting together and getting into this kind of mania, right? Of something that in hindsight, because of the bad outcome, whether it's an economic collapse or a bunch of people in a cult committing suicide, appears obviously quite delusional. Okay, so I'm going to go back to another economic example just because it's been in the news recently. So many of you are familiar with Bitcoin or cryptocurrencies in general, right? This digital version of currency that tries to get away from the downfalls that you have with government-issued, kind of centralized currencies that we are most used to. So I'm not going to go in and explain all about cryptocurrency and Bitcoin. I think most of you are fairly familiar with at least what they are. They're a huge, attractive, basically speculative asset at this point, as opposed to a currency. You could say it's still a currency, but it's used mostly as a speculative asset that people are investing in. So if the value goes up, you can cash in on that, and if the value goes down, you can lose. So it's got this, a lot of the markers of what you would see with stocks, right? Stocks and bonds, something that you invest in that can go up and down. So it is prone to, potentially being a speculative bubble. Cryptocurrencies could be a speculative bubble, and it's actually characterized as such by a number of notable winners of the Nobel Memorial Prize in Economic Sciences, by certain central bank officials, and by notable investors. So there are investors out there who see cryptocurrencies, and particularly Bitcoin, as being so volatile that as something to invest in, you could characterize it as a speculative bubble. And you've seen a lot of ups and downs, and things that you could define as crashes over this last few years. In this month, so recently actually, there is the collapse of Terra Luna, which is a cryptocurrency or kind of this. Well, I'll explain the mechanism in a bit. It's actually two currencies that are brought together in this kind of balancing act that's supposed to stabilize the coin. But Terra Luna is a cryptocurrency called a stable coin, and it's stabilized by assets that fluctuate outside of the cryptocurrency space. And so what that means is, just as you can try to stabilize a regular currency by, let's say, backing it by gold, stable coins try to tether themselves to something like the US dollar. And so whereas cryptocurrencies are normally quite volatile, like Bitcoin, stable coins try to stabilize that volatility by tethering themselves to something like the US dollar. Well, this did not work too well for Terra Luna. And just as a few weeks ago, it wiped out almost 45 billion of market capitalization over the course of a week. So let's just explain the mechanism a little bit. I'm not going to get super deep into it, but I just want to show that, again, people will try to do these kind of financial engineering tricks, and they'll do it in the cryptocurrency space, and people will once again get really excited and invest a lot of their life savings into these things, only to have it collapse. And so these bubble mechanisms are just baked into. You can't get away from them, right? They are eventually going to happen. So stable coins, though, are just yet another thing that was invented so that crypto investors could lower the volatility in their portfolios. And so stable coins claim to be backed by the dollar, right? It's just as you would hold dollars in reserve, kind of like a gold standard currency. Algorithmic stablecoins essentially trade ties to the dollar for decentralization. So if you tie or something, if you peg or tether your currency to something like the US dollar, that's almost a form of centralization, because you kind of have a single point of failure. If something happens to the US dollar, something's going to happen to your currency, right? So they try to decentralize it in the true kind of dream of cryptocurrency by adding these algorithms to it. And we're not going to get into all how that happens, but think of it as layers of financial engineering that are sitting on top of a currency to try to kind of play whack-a-mole, really, right? Every time you do something, you lose something else. There's always these trade-offs. So, we're going to tie ourselves to the US dollar, but that's kind of a point of failure. So now we have to go decentralize it more. And so they add all these layers. And you see this in the investment world all the time, right? The 07, 08 crash tied to mortgages had all these crazy, investment vehicles that were, essentially created with algorithms and some fancy mathematics. So you add layers and layers, and it hides a lot of the underlying danger of what's happening. And you could say that that's what happened with Terra Luna. So Terra Luna, it's kind of like two coins that play off each other. Okay, but if you've got the demand for one that goes up, the price is going to go up because of supply and demand, the usual relationship, right? And so you will create more of one coin that will increase the supply, that will make the price go down, and then the peg will be restored, and then the inverse is also true. So if you are on Patreon, you can see the image I'm using. It might be a little hard to follow this if you're not used to some of this financial jargon, or if you're not, if you're just following along with my words, hopefully you can visualize in your mind. But essentially, you've got this usual mechanism where you try to maintain the peg of your currency to something like the US dollar, right? So if the demand for something is really, really high, then the price is going to be higher, let's say, than the dollar, right, relative to the dollar. And if the demand for that coin goes down and it drops below a certain level, then the price is going to go down relative to that dollar. And so if you have very high demand, you are printing or increasing, let's say, the supply of a certain coin. Eventually that supply gets so high that you've got this drop in price that will happen, because that's how it happens with supply and demand usually. And then you got the inverse, right? If the demand goes too low and the price drops, you'll start to destroy the cryptocurrency, and so the supply will start to decrease, and then the price goes back up relative to the US dollar. So basically what I'm saying here is you've got this kind of built-in equilibrium or mechanism that tries to maintain the price of the cryptocurrency relative to the dollar, and that's how you control the volatility. Okay, so that's the basic idea behind stable coins. Well, in the case of Terra Luna, they've got this kind of fancy financial engineered situation where you have the Terra USD as one coin and the Luna as another coin. So you kind of got these two coins that are playing off each other. The idea is that you can always exchange one Terra USD for $1 worth of Luna. Okay, you can always make, it doesn't matter what's happening to the prices of the coins themselves, you can always make that trade for one Terra, $1 for one Luna. Okay, so you burn a Terra USD and you mint Luna in order to earn a profit. So there's this arbitrage possibility that can happen. In other words, if the Terra USD coin, let's say, drops to 99 cents relative to $1. Okay, so just like the previous, we've got this kind of supply and demand, the usual market fluctuation happening, and the price of that coin can change relative to the dollar. So let's say it drops relative to the $1. Well, now my Terra USD is worth 99 cents, but I can always exchange it for $1 worth of Luna. So I'm going to burn my Terra USD and get 1 Luna worth. So that's called arbitrage. Anytime you try to take advantage of the discrepancies between the prices of things like currencies or other things, that discrepancy, if you act upon it fast enough, you can gain a little bit of a profit. And if you do that writ large, then you can make potentially a lot of profit. And so that's called arbitrage. So as more and more people are holding the Terra USD, try to earn, let's say in this example, this 1 cent profit by burning it for Luna, the supply of the Terra USD would reduce, and then the demand would rise, and then its price would rise until it hits its $1 peg. So again, it's just this way of trying to stabilize the volatility of the cryptocurrency. So again, you've got Terra USD cryptocurrency, its price starts to fall, it's not worth as much anymore. So I'm going to burn it and trade it for this other cryptocurrency called Luna, because I can always do that for $1. That price discrepancy allows me to earn the 1 cent profit. I'm hopefully going to do this thousands and thousands of times to make a worthwhile profit. But the way that arbitrage, the people acting on these arbitrage opportunities, the way that changes the supply and demand of the coin, and therefore the price with respect to the US dollar, it has this built-in kind of balancing act. So anyways, hopefully that wasn't too confusing. But now imagine a situation where so many people are trying to take advantage of that arbitrage, right? Where the price of the Terra USD actually rises. So now Terra USD is worth a lot. It's, 1 cent more relative to the US dollar. Now that means that people who are holding the other Luna coin realize that if they burn $1 worth of Luna, they can get a Terra USD and make an extra cent profit. So it's the exact same thing, but just the universe. So at the end of the day, it doesn't matter if you're not following all the jargon. The point is you've got these kind of two coins playing off each other. And you can always trade them for that $1. And that causes these little arbitrage opportunities where if the price goes up, I can trade it for the other one. If the price goes down, I can trade it for the other one. And because you've got different investors doing this on different ends of the spectrum, you essentially stabilize the cryptocurrency overall. And so at a high level, stepping back from this whole thing, it becomes an attractive investment for investors in cryptocurrencies to invest in something like this, because not only can they try to make profit off this arbitrage opportunity, but the price should never fluctuate too drastically. So it's kind of a more stable thing. Okay. Now, so what happened? So again, we've got this kind of crazy financial engineering situation where you try to stabilize this coin and you're doing it with some fancy math and algorithms, and it should work, right? But something can always go wrong. Well, something that happened was a large number of people actually held the Terra USD, one of those cryptocurrencies in that balancing act, into something called the Anchor protocol, which was basically this savings account for Terra USD that had a 20% interest rate, which is good, right? For any savings account that has a 20% interest rate, that's probably something you're going to want to hold it. So prior to this Terra Luna crash, you had 75% of all Terra USD in circulation was deposited in Anchor, this savings account with 20% interest. In March, Anchor replaced their 20% interest rate with a variable rate. And so large amounts of Terra USD were withdrawn from Anchor. So many burned the Terra USD in exchange for Luna using that mechanism I just explained. And so the supply for Luna ballooned, which made its price tank, right? Again, supply demand. And both Terra USD and Luna ended up crashing. And so the entire crypto market has been slashed by more than 1/2. The entire crypto market, which is 2.9 trillion, from 2.9 trillion to 1.2. So I shouldn't be laughing, because obviously people had a lot of their life savings invested in this, and apparently there was even suicide hotlines that were put up for this situation. And so again, regardless of how much you understood behind the mechanisms, what we're talking about here is some fancy financial engineering and jumping on kind of a hype train of cryptocurrency, which is going on right now, convincing people that they've created a more stable version, a more lucrative version of this. And inevitably, you've got some kind of organization or some protocol that gets created somewhere within this environment, and then some business decision was made, which made people all of a sudden act a certain way, and it basically pushed one of the coins off the balancing act, and then the whole thing crashed. And when you step back from these things, like, look, it doesn't even matter how it happened. there's always going to be this risk of a speculative bubble that can happen anytime a group of people can get really excited in something and just go for it, right? The madness of the crowd, right? So we have gone over the South Sea bubble, right? The British Railway bubble, the 1920 stock market, of course, the dot-com bubble. We use cults as an example, and then one more economic example with the Terra Luna crash that literally just happened this month. Took a look at that mechanism. When we step back from all these, we can see the properties of bubbles in general. They have 4 common attributes to manias, and this is what is talked about in the book that I'm referencing, The Delusions of Crowds. Number 1 is over-optimism and intense speculation, okay, which is obvious. So we just saw that with the Terra Luna example. We saw this with the railway example. All those other examples that I gave, the dot-com crash, it was this over-optimism and intense speculation. 2, leaving good situations in life, like family and jobs, to pursue the speculation or belief. So this is when you really get into the delusion or the madness, where you get caught up in that over-optimism, where you start to sacrifice things like time with your family, or people will leave their jobs just to spend their time because they think they've really figured something out in the market. They'll start to dump a lot of their life savings into it. 3, becoming angry at naysayers regardless of how bad things look. So even when people are giving you like obvious red flags, if you just look at the basic mechanisms of finance or whatever it is, markets, you can see that this is maybe not a good thing to sink all your life savings into. Or in the case of cults, they'll do the same thing. When you start to really believe crazy interpretations of the Bible or whatever it is, whatever the cult is, aliens are going to come down and they're going to take us to heaven. And people are just saying, look, maybe just slow down and think about what you're saying. I don't think you realize just how crazy. It's almost like they don't hear it. They're getting caught up in this frenzy, and they will become angry at naysayers. They will justify, no matter how crazy it is, no matter how red flaggish it is, they will just justify the decisions they're making because they're caught up and they can't stop. And then 4 is making extreme predictions, this kind of prognostication, where people will start, like the end of the world cults, will they start saying, I think 2 months from now, the earth is absolutely going to end because, we've taken a look. And it sounds so crazy to anyone from the outside, but the people who are inside and caught up in this frenzy, what they're doing is, it's kind of like the numerology with the Bible or something. You start seeing patterns. I mean, humans are really, really good at seeing patterns. And that's, of course, a good and a bad thing. It can help us survive. It does help us survive in many ways. But under these kind of contrived situations, which I'll talk about in a bit, under modernity, right, where we do things like have stock markets and, established institutions and, even religions and things, when you start to put a lot of those in place, that pattern recognition can actually come and bite you because you'll start to see patterns everywhere. And so you'll start to make these kind of ridiculous predictions, but they will make sense to you because to you, they logically add up. So a bubble is anything where the asset prices are much higher than the underlying fundamentals can reasonably justify, right? And you get this overly optimistic projections about the future. And so that's what we've seen, whether it's economic, whether it's cults, whether it's anything, any kind of frenzy that happens in groups. Okay, well, the book, The Delusions of Crowd, kind of talks about these mechanisms in terms of 2 biases, and that's cognitive dissonance and confirmation bias. And so these are things that people that do on a regular basis. So the cognitive dissonance, which is a pretty popular term these last 5 years, this pops up all the time. I don't know why it's particularly popular now, but you hear about it a lot. I guess just maybe it's because of the way the polarized, political environment that we're in. People talk about echo chambers and things like that. Well, cognitive dissonance is anytime a narrative and data are in conflict. So the perception of contradictory information or beliefs clashing with new information. So if you have a certain worldview, right, based on your experience or your echo chamber or whatever feeds into that, and then all of a sudden you are presented with contrary evidence, this causes, a problem for you, right? It's got contradictory information to what you believe. You have a certain worldview and you expect to see things go a certain way, and then all of a sudden something is presented with you that doesn't agree with that, and that causes this kind of internal consternation where you can't handle it. And so people will actively work towards reducing that cognitive dissonance. In other words, you can't just exist in a state where you have these 2 opposing thoughts in your mind, that ambivalence, right? You have to do something to resolve it, and people will handle that or resolve that by usually investing even more in their narrative. So in other words, I'm going along in life and I have a certain worldview and I expect everything I see and hear to conform to that because that's how I think the world works. And then all of a sudden presented with something contrary. Well, instead of kind of reasoning about it and saying, okay, well, maybe I should change my view, we tend to just invest even more into our own narrative. And so we will, and that's kind of going back to this becoming angry at naysayers property of bubbles, right? It doesn't matter what I'm being presented with or even how much. Sometimes I'll just sink even more deeply into my narrative. And so we as humans do this all the time. And so this is one of the reasons why people will get caught up in bubbles, no matter how ridiculous they are, no matter how damaging they are to their own lives and to their families' lives. Confirmation bias is another one. This is a type of bias thinking. This is the tendency to favor information in a way that conforms or supports to prior beliefs, ignoring the contrary information. So kind of similar. I like to think of confirmation bias as basically once you think something is a certain way, that's the only thing you can see. Okay, so imagine that it basically affects your interpretation of things, right? If you think there is a systemic problem that is baked into the system, then you're going to see that everywhere, even when that's not the case. That's confirmation bias, right? So you interpret ambiguous evidence as supporting existing attitudes. This ends up biasing the things that you search for, the way that you interpret, even your memory, the way that you recall information. You will think that something happened that didn't, because it's you're taking what you remembered and you're conforming it to your built-in biases as opposed to more the objective reality. Now they say that, psychologists say that confirmation bias cannot be eliminated, but it can be managed. For example, with critical thinking skills, right? So if you're aware of this confirmation bias, so that when you're searching or interpreting or recalling information, and this is just something that humans do, you can try to keep that in check and maybe try to be more reasoned and balanced in your understanding of the world and the decisions you make therefrom. Okay, so we talked about, these bubbles. We talked about the properties. We talked about the built-in biases that people have. And what I want to talk about now is what I call the cost of complexity. And so the stance I'm kind of taking on this is that, a lot of this is viewing this kind of feeding frenzy, this delusions of the crowds in a purely pejorative sense, right? Like, this is obviously a bad thing. And there are bad outcomes, right? Because people will lose all their money. People will commit mass suicide. I mean, there are obviously bad things that happen. But if you step back and see the bigger picture, you can also say that, this is the cost to complexity. So let me give you an example of what I mean by that. For those of you on Patreon, you can see what is called an ant mill. An ant mill. So I like to use ants a lot, right, when I talk about complexity. So what you're seeing here in this GIF, this video on the right, is these ants swirling around in circles. And if you're not on Patreon, you don't see this, go ahead and YouTube this. Go Google ant mill. It's also called the death spiral. And it's these ants who have essentially lost the way from the usual colony and have started just hundreds and hundreds of them are just going in circles and going in circles and going in circles. And they'll do this until they get exhausted and die. And I don't know if they always die, but that's something that can happen. So you have, and so the way this happens is ants are usually following a pheromone trail, right? These chemicals that get released into the air, the other ants pick up on those pheromones, and that's how they know, where to follow. If one ant or a few ants go off the usual trail and other ants decide to follow their pheromones, and then those ants follow those pheromones, and on and on and on, you'll kind of have this diverging path where hundreds of ants go away from the rest of the colony and start getting looped into this death spiral. Okay, so they're not doing what they're supposed to, right? They're not following the usual trail of ants. One ant went away, and everybody started following that pheromone trail, and it got caught in this feedback loop. And so now they're all kind of releasing their pheromones, and they're all following each other, and they're spiraling and spiraling and spiraling. And so you've got this death spiral, which is called an ant mill. So again, go check that out if you don't see it on Patreon that I'm showing now. Well, this is a property of complex systems. And so the reason why I want to bring this example up is because I want to highlight the cost of complexity, the cost associated with things that actually do work when you step back and get the bigger picture. So if you zoom in and you look at these ants doing what they do, it looks ridiculous, right? Why would nature design ants to in such a way that they could get caught up in this ridiculous situation where they spin and spin and spin until they exhaust themselves and die? But the same thing that makes them die in the death spiral are the things that make them so successful as a species, right? They're able to solve complex problems. They're able to make extremely complex challenges tractable because of this property, right? So in other words, the same things that make you successful are also the things that can get you into trouble, right? And in aggregate specifically, this is definitely true in nature. Many things have to die so that many things can live, right? This is what you have mechanisms, powerful emergent mechanisms in nature that allow things to survive over the long run. But those same mechanisms are going to lead to things like this. So when we look at the economy, right, you're not going to stop bubbles from happening. They have to happen. The reason the market works, right, regardless of how well you think it works, the reason why it works at all is because of things like bubbles, right? You have to have those things. The mechanisms that cause bubbles are the same mechanisms that allow the market to work successfully. Okay, just the same reason that the ants have attributes about them that cause death spirals. Those same attributes are what allow overall the ants to be so successful as a species. Okay, so we take certain properties of complexity like feedback loops. Those can work for or against you. And so in line with that, which I kind of want the take home message here is that, if you stand too close to the situation, it's going to look delusional. But if you step back and see the bigger picture, if you're able to, you'll be able to make sense of it. And a lot of times we can't do that. We can't get the bigger holistic picture because there's, the epistemic uncertainty is just too great. We can't understand the big ultimate reason for things. But that doesn't mean they're not there. And as a general property, we know that this is the case, that if you take too narrow a slice, a too myopic view of something, it's going to look pretty delusional. But that doesn't mean it actually is delusional or is wrong. Right? In fact, it's only wrong under the contrived situations of modernity, right? Modern life creates a lot of contrived situations. Even participating in the market. I mean, there's something very natural about, organisms competing with a currency in the market, but there's also something kind of contrived about, investing and trying to, get a return on something. I mean, nature doesn't care if you invest money, right? So there's something contrived about that situation. And you see this in sciences. I think of the French paradox, right? Where, back in the day, I don't know if they still talk about this, but they used to say, why are the French not dying earlier, right? Because they seem to eat a lot of, butters and creams and, they drink a lot, and their diet does not necessarily reflect what science at the time was saying was healthy. And so they kind of had this French paradox where, why do they have good life expectancy? Maybe even one of the best if they're eating all this presumed crap. But of course, it was the contrived, bad science that was happening at the time that thought, saturated fats were bad, and maybe, alcohol was always bad. Maybe there was a dosage there where it wasn't so bad. Maybe at the time they didn't realize red wine, and that was kind of the answer to the French paradox. Well, it must be all the wine they're drinking. Look, the reason, what this is science has an extremely limited view of what health is, right? And so they take that kind of 1980s, 1990s, what is now quite outdated nutrition advice of what is healthy, and they look at a diet that's loaded in saturated fats or something, and they say, well, this is a paradox. Well, it's not a paradox. The way that you resolve paradox is you take away the thin slice and you get a broader view of something, and that can't happen until usually decades and decades later when enough time has passed. And now we know, saturated fats are, although this is still up for debate, but are largely regarded as something that's probably not that unhealthy at all. In fact, our ancestors were probably ingesting a lot of saturated fats. And so, it was that outdated, myopic, overly contrived view of reality that made it something look like a paradox. But when you got more information, a bigger picture of how things actually work, and you take a look at human survival over time, that's not actually a paradox. So it's that idea that if you're taking too thin of a slice of something, things are going to look wrong. But it's not because the situation actually is wrong. Your view is just too myopic. You don't see the full thing. And again, a lot of times we don't get to see the full thing. And so something might look delusional, but this is why if something has survived over a long period of time, the safest assumption is that it is correct, even though there's a good chance you're not going to be able to uncover the causality of why that is. Okay. So, and also, we talked about system 1 versus system 2. System 1 being the rapid, emotional, kind of intuitive way of thinking, which is like 95% of what we do because that's, our 50,000-year-old brains. That's primarily how they operate. And then that's system 1. And then system 2 is much more, slow and logical and kind of analytical. And system 2, it might be obviously what you would associate actually with science, right? But there's far more narrative to science than laymen tend to realize, right? Data doesn't necessarily save you from narrative. In fact, data can supercharge narrative because the data, when you have some of it, can give you the illusion that you must really be doing something intelligent and you must actually understand the situation. But again, going back to this previous visual that I have for the Patreon viewers, you can see that thin slice. Data is always going to be a very thin slice through all of reality. And if you anchor too greatly on the data, you can wrap all kinds of BS narrative around it. And the problem with that, and you get into the same problem with mathematics, is that you put so much faith in what looks like something that's rigorous that you really invest in your narrative, right? Because it looks scientific, because it looks like it's rigorous. There's numbers, there's data, therefore it must be true, and people do this all the time. So data can actually make narrative worse. So even though you have something like cognitive dissonance, which is when narrative and data are in conflict, that's typically how we think of it. Data can actually supercharge narrative and make the problem worse. So data and evidence are a very thin slice used to anchor a narrative. And if you think about, the problem like the replication crisis, where 70% of, the software sciences can't even be replicated, or they have very little evidence that they can be replicated. We have a lot of problems in science and physicists chasing too much elegance and all the stuff that I've talked about before. A lot of that is because of this overinvestment in system 2, this assumption that system 2 must be better, and not realizing just how much bias and narrative is caused by data. And data is not the opposite of narrative, right? Evidence does not necessarily get you away from narrative. It does not objectively cut through the bias of humans. There are times where it can, but it is not guaranteed. And a lot of times it can do the exact opposite, is what I'm saying. And then finally, and I've talked about the benefit of turmoil before. I think it was in the library episode, right? The immortal library. Collapses bring benefits. Like nature doesn't prefer good outcomes over bad ones, right? Nature just is. And so again, if you're zooming in close to something like the railway mania that we talked about, people were giving up their life savings, and there was this over optimism and speculation and investment in the railway. Looks like a bad thing. It's mania. It collapsed. Nothing good about that. But then over time, you step back and realize, well, actually 6,220 miles of railway, which is just over 10,000 kilometers of railway was laid during that time. So in the moment, it was bad, but overall, there was a reason for it. You could argue, right? Something good did come out of that. The dot-com mania led to large amounts of fiber optic cables being laid, right? Maybe too much, but still, that laid a lot of infrastructure. So again, you're standing too close. You got a really myopic view of something. It looks bad. You allow more time to pass. You get a more holistic, bigger picture of something, and you realize, maybe that was kind of meant to be, or regardless, it was the system doing what it does. Okay, so there's always a cost to complexity. There's going to be bubbles. There's going to be manias. There's going to be bias. There's going to be, a lot of this stuff that looks bad in the moment, but when you step back and get the bigger picture, is not necessarily so. There is a benefit to turmoil. You need that variation. That is how things become tractable. And look, at the end of the day, we compare the system 1 to system 2. I think this is a really outdated way of looking at things. Or you could still say, okay, yeah, there's system 1 and system 2. But this idea that system 2 is the type of thinking to be favored, and that system 1 is kind of this outdated reptilian, old way of thinking that really makes living in modernity hard. In a way, that is true. I think that a lot of times, humans aren't, naturally going to pick apart things logically and analytically. And if we think about, the Enlightenment world and the Industrial Revolution, where a lot of the things were very deterministic and cogs and pistons and slide rule and that type of engineering and that type of world that was being brought into being, logical analytical thinking served you quite well. But I've talked about this before. The way that technology is moving now is we're coming full circle, where a lot of the technologies that we're building now are softer. They're more heuristic, right? Machine learning, AI. We're getting away from programming computers explicitly with rules, and we're using softer statistical methods that approximate their outputs. And so I think we're going to be coming full circle, where system 1 is actually going to be a far more powerful way of thinking. I think it always has been a far more powerful way of thinking, but it's actually going to have a stronger utility in society as the technologies we create become higher and higher level and more abstract and softer. It's going to be more of that intuitive, high level thinking that's going to be far more important than the low level stuff, which has already been taken over, by machines, and is less relevant, I would say, to operating in society. So I think system 1 will end up being recognized as more powerful in the long run anyway. Okay, so that is it for this episode. We covered quite a few aspects. I know I got a little jargony around some of that Terra USD Terra Luna collapse stuff. But I hope that made sense, right? You know, it's in one context, it is right to think of what happens in aggregate in crowds as a bit of madness, and we have to be careful. But also, when you get the bigger picture, you know, that really is just the cost of complexity. I think that when people get together, they can solve problems in groups. There's a real wisdom to the crowd, and I think over time it really will be seen as wisdom. But in the moment, it can definitely look delusional, and it's up to us to maybe not get caught up in the death spirals like the ants do. Hopefully, you're not part of that ant group, and you're part of the other ants that go on to survive. So understand that this is a property, that there is a cost to complexity, and try to put yourself on the right side of that equation. So, thanks everyone for listening. If you want to help support NonTrivial, go head on over to patreon.com/nontrivial. And for a few dollars a month, you can help support what I do. And of course, again, that gives you access to the visuals that I use on these episodes. So thanks again. I know there was a bit of a break there, a few weeks from the last episode. So I'm trying to get it back on track. I'll try to get that next one out soon after this one. The book is already read for that one. So pay attention for that. Thanks everyone for listening. Until next time, take care.